the underlying economy is beginning to weaken in a fundamental sense. But on the positive side, there's a measure called JOLTS, which is job openings. That measure crossed 10 million. There are 10 million jobs out in the US market that are unfilled today. Now, why is that? There are any of a number of reasons. One is these jobs don't pay enough. And you did see Walmart this week increase pay, I think, another $1. I think they're going to something north of $16 for I think it was 500,000 of their employees. So yes, low wages is one. Skill set mismatch is another. And of course, as technology is evolving faster and faster through our lives, this is becoming a bigger problem. We do believe that corporations are going to have to start training and bringing in some of these people who do not have those skills. We've seen corroborating the strong employment report, initial unemployment claims have come down pretty much week by week. So they peaked, just for perspective, at 6.1 million claims at the worst of the coronavirus last spring. And now we're down to 340,000, huge improvement. We're not that far above where we were pre-coronavirus, so the 250,000 range. So we're getting back to normal, lots of improvement there. In the personal income report, we saw a 1.1% increase in personal income. Nice increase. We saw the saving rate go up to close to 13%, I think, if I'm not mistaken. And so that threshold for the savings rate, before the coronavirus, it was in the 7 to 8% range. We're still well above that. So that's consumer firepower that is available. We're seeing in the housing sector good sales, both new and existing home sales, very good. Although I will say that in the new home sales report, the month's supply of inventory effectively has started to creep up. So that's an interesting nuance. The pricing in housing has been extremely strong. And there's been a little bit, I would say, of a panic buying in some parts of the country because supply has been so tight. And if the month supply now are starting to increase, that will cure the pricing problem, we think. The Purchasing Managers Index was very strong for August. Orders booming, up at 66.7, and that was an increase from prior months. So it's been levitating for quite some time now, as businesses have been scrambling to catch up to consumer demand as their shelves started emptying out. They were way behind the consumer, as I've mentioned, starting before the coronavirus. They were pulling back on inventory growth and pulling back on capital spending because of an inverted yield curve in 2019 and the China-US trade conflict and saber rattling. So before the coronaviruses, businesses were postured very conservatively. The coronavirus hit, bam, they shut down. Just as with PPP checks, the consumer opened her pocketbook and started spending on goods and started spending at a very rapid clip. Now, I've mentioned before that goods are only 1/3 of total consumption, and that's all that consumers could spend on, as most services were shut down. So disproportionate spending on the good side, and businesses have been scrambling to catch up ever since. We are also seeing them trying to catch up on the capital spending side. So non-defense capital goods, ex-aircraft, are really good leading indicator of capital spending. is very strong. Not surprisingly, we're seeing a shift towards technology spending to increase productivity and to get in tune with the digital age, now that we're probably all going to be working on more of a hybrid schedule. So industrial production, very strong, 1.1%, or 1.4% in the manufacturing sector in the last report. So businesses probably are catching up with demand, maybe a little bit too much so. So those are the positive indicators that we've seen in the last month. The negative indicators are quite instructive. First, the University of Michigan Consumer Sentiment Index dropped precipitously back to a level we hadn't seen since 2011, when we were grappling with a European sovereign debt crisis and fears that we'd end up in another 08-09. So that's a big drop. We're also we saw retail sales drop 1.1%, and that is a nominal number, which means it includes inflation. The CPI inflation was 0.5 that month. So in real terms, the drop in retail sales was probably closer to 1.5%. Sequentially. That's a huge, huge drop in 1 month's time. Now, why is this happening? I think what we're seeing in the survey is consumers' inflation expectations are going up, and they're feeling that they're losing purchasing power. If you look at real average hourly earnings, so taking out the inflation bump, real average hourly earnings on a year-over-year basis are down 1.2%. So the consumer viscerally feels that, probably looking at the gas pump in California, which I believe is back over $5 as it is elsewhere in the country, and food prices because of supply chain issues also rising rapidly. I think one of the most surprising numbers that I saw during this last month, and a continuation of a trend, or what seems to be a trend developing, auto sales. Auto sales peaked at 18.5 million units in February, I believe. And as of August, we just got this number this week, they've dropped to 13 million units. Now that's at an annual rate, and that's a US only number. That is a 30% decline, and that's not annualized. If we annualized it, it'd be like a 60% decline. But I do not believe that the auto market has truly weakened that much.